Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. The macro environment under which we operate certainly has turned around quite a bit, or at least has a lot more ingredients to it than what it probably had about 6 to 9 months ago. So lots more to monitor and lots more to think about. It is at these times that we try and get in the right guest to talk about how does she or he think about the global environment. And Maneesh Dangi joins in right now to talk about that. Manish, great having you. Thanks for joining us.
Talking to you always.
Sorry for that small disturbance. Okay, Manish, just wondering, before we get to what the backdrop is looking like, can we just broadly talk about whether macro investing, which is not so prevalent in India, can it kind of become mainstay, so to say? Because hitherto in India, we are usually bottom-up micro investors, and that's how most of the narratives are placed forward.
Sure, Neeraj. See, macro investing is another frame through which you approach investing, right? And so it's not one or another, but it could fit into anyone's portfolio as a part of portfolio in terms of approaching asset market. So let me explain in terms of how I look at macro investing versus, let's say, compare with its a cousin called bottom-up investing. More through the lens of what are the similarities and dissimilarities. Both of them have their own entry styles. The entry style of a bottom-up is micro. It sort of looks for good businesses and good microeconomics of sorts, policy and such like. Whereas the macro is on entering reflationary setups, in which setups like policy setups which facilitate profit cycles and risk taking. So that's the difference of entering style. The exit styles, of course, both have their own unique exit styles. The bottom-up investing is about exiting bad businesses and bad microeconomics in terms of policy, whereas macro exiting is about weak macro. So again, basically, when the policy environment sort of turns for worse in terms of risk taking or profit cycles, macro sort of advises you to exit. So in a sense, I think for your audience, who understand bottom up more as, how to track profit of the firm, macro is also about profit, but it's about profit pool of the all firms in a sense. And I don't know whether, I think we've spoken about it, Niraj, but I made this point to you once that, profit pools of all the firms somehow are somewhat independent of the firm themselves. Whereas, it's actually dependent on the policy cycles, demographics, and debt, so which are broad macro frameworks of economy. So, okay, to summarize, basically, you asked me whether macro can also become in vogue. I think, given the micro investing or bottom-up investing is more prevalent, I would assume that macro has less competition, someone who's actually approaching investing through macro. And perhaps has more risk premium available if you're able to navigate macro well, So yeah, that's how I would look at and actually promote macro investing, for your investor.
Yeah, well, but it's all. I mean, I think what most people try to do is have a 10% view on the macro and 90% view on the micro, and maybe at some point of time, as the economy grows, etc., and as more of your breed comes to the fore, Maneesh, maybe this can improve. But anyway,
just a second. So in a sense, Neeraj, I'm sorry to intervene, but
sure.
Both of them are actually dependent on each other. In a sense, macro framework relies on bottom up to weigh the relative valuation. Okay, basis the relative profit pool. Between ICICI and HDFC Bank, how much of the total market cap should be sort of divided is the good work done by bottom-up investors. And bottom-up, in turn, relies on macro policies, which will counteract on excesses on either side and deliver reasonable expansions in the economy. So, in a sense, they are truly good cousins, so to say.
Yeah. No. What I meant was in the eyes of the public, the quantum of conversation that moves up. Right now, people rely on it maybe 10% or thereabouts. because for the right reasons, maybe thus far it's been dominated by the micro top or bottom up, or not necessarily macro investing. But let's try and do the next 25-30 minutes on how you see the macro, Manish, and maybe start with a bit of a global macro, if you will, Manish, because this week was inundated with central banking conversations, right? Brazil, outlier in idiosyncratic issues, but Canada, UK, and of course, we have small news back home wherein Shaktikant Das has got an extension of 3 more years, if it means policy continuity or stability, what have you. But how is the macro construct, according to you, on the global side?
So the most relevant sort of input one is actually sort of viewing right now is the inflationary setup in the world, and thereby is speculating on what you call central banker reaction function to it. So they are the two major parts, that for a macro investor is the most relevant one. So just to step back, since macro investing has identifies distinct cycles of investing. The first one is deflationary cycle, where you sort of make maximum money because you're actually siding with policymakers when they try to pump prime the economy and actually lower real rates. Then we enter the mid cycles, which I call them re-leverage cycle, where the consumer and investors actually begin to lever up, corporations and such likes. And that is a period you make reasonable returns, not excessive returns that you make in reflation. And then there is a late cycle where inflation begins to pick up. And so that is what is the true evil, so to say, for macro investors. If they identify it, they must exit, because eventually policymakers will lean against this and would essentially mean that, asset investors, mostly the risk investors, will end up losing money. So in that framework, Niraj, the most important thing, that the question we are asking ourselves, that are we're truly out of reflation cycle. I remember having conversation with you in August, and I made this argument with you that, reflation, which is all about, policymakers actually trying to get you out of the rut of, recession or such like, is over. And you will incrementally see all actions from central bankers and other policymakers against or lean against of some sort against this wind, so that the inflation can be tamed. But generally, mid cycles tend to be long lasting, 1, 2, 3 years sometimes, but they also tend to be sometimes shortened. So what are we trying to do? We're trying to assess, when I'm thinking of global macro and local macro. I'm trying to understand whether the inflation is rearing back too early, and is it transient or more permanent? Is it only a US phenomenon, or it's pervasive across the world? And also, is it to do with India as well? And how exactly the reaction function of central bankers will play out, and more like, all policymakers, including the fiscal ones, will play out. Okay. In that setup, I begin the answer in a sense that the global policy setup, primarily through the lens of monetary policy, is right now, reliant on this view that, the inflation we had post-pandemic, it did happen because of some transient factors, regarding the supply chain disruptions, which are not necessarily permanent. Okay. But for far too long, the inflation has sort of sustained at higher level in Western countries, and they've surprised sort of dramatically more than what markets and the central bankers anticipated. And so to that extent, one begins to wonder whether it is actually transient or not. And we've made this argument many times that, it is more durable than what deflationistas and central bankers think. Of course, it's not the hyperinflation that I'm anticipating, just because, hyperinflation is not a deal on table, in a sense that I'm very certain that the policymakers will come hard at you if there is inflation. And therefore, a lot of people who are actually viewing asset markets through the lens of hyperinflation is the only way to protect yourself in real assets like real estate or stock markets are actually getting it wrong. Because if there is if there were to be a sight of hyperinflation, central bankers will come after you in a manner that, they will actually reduce the tendencies of that dramatically. Okay. Neeraj, in a minute, I think that the inflation setup is such that it's likely to be more durable. Okay, primarily driven by two or three factors. One is the demand curve after the COVID. Okay, has actually shifted. Goods demand curve, more specifically, has shifted right, which essentially and has gotten flattened in a sense that price sensitivity to goods demand has actually lowered, has come down because of COVID. Goods I'm talking of, okay? So basically, even at a 5% or 10% higher price of, let's say, Maruti here, or a two-wheeler, or a sort of or laptop, you're ready to, buy as much, So the sensitivity has reduced, and to that extent, so when this happens, when the demand curve sort of flattens, you tend to have producers actually taking prices higher eventually. So I think that is inflationary, which is more durable in nature. The supply curve on the services side, okay, has actually steepened because of the COVID protocols, which essentially means that now restaurants and airports and ports are unable to supply the same that they had capacity for. And therefore, a relatively less demand of services itself sort of induced overwhelming of services, and therefore, have more inflation. So both demand supply settings are such, in terms of, the way curves have shifted, it seems, there is, seeds of, more inflation, so to say, in the future. Alongside, an important sort of lever of inflation has always been energy inflation, and so has been the energy has been the key binding constraints of growth also in the historically, especially in the industrial era, because that is the only, most scarce thing, so to say, we have, outside of people, let's say. I mean, that's not a problem in India, though. And energy shortages today, again, has sort of some durable feature to it because of the long under-investing of sorts in sort of hydrocarbons. And so, therefore, I think this will be a permanent feature and will continue to induce inflation over long periods of time. So, Niraj, I'll just pause here, and I don't know whether I'm rambling, but my sense is that the inflation setup, Niraj, is somewhat more durable for the reasons that I mentioned. There are many more, like labor shortages. Some of them are fleeting and will go away, but some of them actually will sort of semi-permanent of sorts, and would continue to stay and hurt us in the next 6 to 12 months. Okay. Now, given from a purely reaction function point of view of central bankers, inflation has gone on for far too long and is now sort of staying at far too higher level for one to imagine that central bankers will continue to be complacent. And therefore, my prognosis now is that over next 6 months, now what you've seen in Russia, Brazil, in terms of surprises on rates, and what you've seen in terms of paper outcome, when it would end, somewhat of a surprise, which has sort of led to a sharp sell-off in bonds in US, particularly in the short end. I think, over next 6 months, you are getting into a policy cycle where both central bankers and fiscal authorities will actually surprise you on tighter side. And that, unfortunately... Sorry?
You mean positively?
No, negatively.
Negatively,
in a sense that the rate tightening would be somewhat higher than what markets are anticipating. Now, again, stepping back, originally I made a point that from deflationary to mid-cycle setup, when you transition, most of the mid-cycle rate hikes, are actually well telegraphed one, and they do not surprise. And which is why equity investors don't really bother about rate hikes, because, it's a good deal, right? That you told me that you're going to hike rates because the economy is chugging along too well. It's only in the late cycle, because of inflation, markets begin to get surprised by the policymakers because they turn more hawkish than what they anticipate. So you call it emergency U-turns of sorts in policy parlance, and I guess some of it is in play over next 6 to 12 months, and that is a sort of a nasty thing for asset markets. So I'm not certain about this. I'm just sort of laying out a setup in which while it's very unlikely that we have already transitioned into late cycle, but and there are most phenomena like credit growth and such like are still like mid cycle, but it seems to me that that some of the infiltration of late cycle phenomena are already there. One of them, of course, better than me, is the exuberance that you see in the primary markets, and the retail investors, not just in US and India, but pretty much everywhere in the world. But also the positive policy surprises, which is the underpinning of late cycle trade. They're already in place. So to that extent, my point in August also was same, that it makes sense to be sort of cautious. But I'm jumping the gun right now. You talked about policy setup.
Yeah, no. So my question is just that. Actually, I'm trying to correlate this, Manish, because you made a very valid point that policy action which impacts investing is the one that we need to watch out for. My question to you, therefore, is: do you reckon that India could be in a slightly different stage of the cycles compared to, say, maybe the US? I'm just using US as a benchmark because when the US sneezes, the world catches a cough, and vice versa. So can India be in a different stage of the cycle than the US? And if US enters a rate cycle, if not already, then will that overwhelm where India is in its cycle?
So I agree with you that India is in different cycle. So if India wasn't on, we were on island, we wouldn't have bothered, because we sort of do not show any significant sign of late cycle. Apart from the excesses on the in the equity side, which is somewhat global phenomenon. But otherwise, credit growth is sluggish. Inflation sort of had stayed elevated in India for 18, 20 months, 25 months actually. So it's not a sort of unique, power play of fiscal stimulus, because there wasn't much fiscal stimulus, and India still, there is a lot of slack. If we were to measure India's output vis-a-vis the pre-COVID trajectory, we're still 10-12% below that, and then you would assume that in that setting, how could inflation come back in meaningful manner? And so you're right, that to that extent, India is behind most advanced economies, more specifically US, given that you referenced it to that economy, because that economy is just 1% below pre-COVID, and we are 12% below pre-COVID, and therefore there is significant slack, and therefore there is more policy room, one would argue, right? Because the RBI could sort of persist with lower rates for longer, and allow a reasonable recovery to bloom in India. But here, the problem is that the inflation channel, for India, and I'm talking of now future, so I agree with you that India is, because behind the curve in terms of recovery, therefore, Indian risk cycle, could be more long-lasting one, right? But the problem is that, the inflation has other channels outside of local demand, and one such channel is, let's say, energy price, that if the energy price, which has risen by 45% last 1 year, it sort of continues to hurt us, okay? Because energy is a chief anchor of India's inflation, given that we are still relatively primitive economy, like less goods and tertiary services, more of primary goods like, food and energy. And pretty much all the food and energy together is 2/3 of inflation basket. And the anchor of that is energy price. If energy prices continue to sort of go up, India's inflation can get into a messy setting. And so to a certain extent, this played out for us in 2011-12, okay? In a sense, high energy prices with high MSPs and food prices led to a massive disruption. So, while our economy was complete then, but we quickly got into late cycle, and, we started to inflate very, very quickly. So to summarize, I think, I would have a mixed opinion on India. In a sense, it seems India has sort of more legroom to play. And it seems Shaktikanta, and the gang actually is of a reasonable view that there isn't a point in tightening Indian rates too early. So they're allowing it to happen. But then I call it a little bit of a dangerous experiment, because this actually dismisses the other channels of inflation. And don't forget that India relatively is a supply constrained and quick to overheat economy. We don't have the sort of cushions that China and US and such like have. So a little bit of a demand overheating, and oh boy, we are at 12%, 10% inflation. So I am not calling for such high elevated inflation, but that channel exists, and I think as investors, I would actually assume that Indian demand recovery has more legs, and then can sustain for longer. But Indian asset cycle since they have channels, through outside world, and the Indian inflation cycle, both seem to have a stronger, exogenous place of shock, in India. And so therefore, let's be mindful of them.
Just quick one follow up, Manish. One view, one outside view, if not an overwhelming view, seems to be that the global supply chain and high demand issues currently might start tapering off post Christmas. This is the first Christmas post COVID, so on and so forth. And come January, February, companies will also get a hang of how to manage this a bit better. And therefore, those inflationary pressures around the world might cool off. That might give a bit of a leeway to others as well. For example, coal prices have cooled off significantly, right, because of some changes that have happened in China, so on. So, is there validity to that argument? And therefore, my major question is: do you think the market will look that far out, or if indeed some of the prints on the vegetables and energy-related prints for October, November start showing an uptake, the markets will get nervous?
So, Neither, I kind of think of, inflation in terms of analogy as a force, as a wind. It sort of moves from one place to another. It's not in the same area always. It doesn't hit the same object. So it goes to, sometimes it goes to sort of steel. Then so you suddenly see, oh my God, steel is cooling off dramatically, and then it enters something else altogether. So it's all about, it's a force. So what it does, that it's a wind which blows in a direction, hits a certain object, to the extent that the demand of that object goes down. If the lumber prices in US goes up by 400%, it goes to the extent that it actually hits the consumer so much that people demand less. So which is the objective of inflation? It's an evil. It actually kills the demand. And so to that extent, don't look at inflation from the point of view that, hey, steel lumber prices are going down, now steel prices are going down, now coal is cooling off. It's entering cotton, and then just after that, it's actually entering aluminium. It sort of entered suddenly in silicon, which is sort of the cheapest stuff that you can acquire. And don't forget that the house prices. India is sort of a serene place. Otherwise, house prices are like super hot in the world, and the consumer is sitting on large surpluses of sorts. And you have this unique setup in which. First time, at least in my lifetime, the bargaining power has shifted to labor from that of an employer. Okay, because we've somehow unionized of sorts, all the labor, because we are outside the ring, unemployed, and therefore, the supply of jobs are actually substantially more than the number of people looking for it. Not just in US, it's sort of pervasive, and you're going to see this in white collar jobs in India sooner than later. So, labor conditions, energy prices, inflation sort of moving as wind from one place to another. It is possible that, some of these supply shocks, will settle themselves, okay? But if it is becoming a force on its own, with sort of real estate fueling demand, the wealth effect fueling demand, and labor shortages sort of sustaining, and therefore, people demanding higher wages leading to higher prices, it sort of can develop its own wings, I would argue. Okay, so if you are Shaktikanta or Pavel, okay, and you were presented this thesis that, man, your economy seems to have sort of, especially in US, and to a certain extent Europe and many other countries, where the economies have recovered. Okay, would you sort of bet your reputation on actually believing that inflation is transient? And would you bet your reputation that even though there is only a 10% chance of a big blow up in inflation, that in last 100 years we've learned this, more so in last 40 years, that any place we have inflation, substantial inflation, it pretty much kills the business cycle far too soon. So given the historical backdrop of our understanding, the philosophy among central bankers would be, listen, let's do a balance of risk argument and tighten.
You think RBI will do that? Because hitherto the Western Central Bank has started curving its arguments. Shaktikanta Das has got a 3-year extension. You think he starts off with this?
Now it's done. You can tighten now. So okay, and so Pavel, I'm assigning sort of 50-50, but anyone comes in US, if it's new, if I and you were there, we would not take this call. I said, leave it. I mean, it's fine. Let's sort of tighten somewhat and see
Yeah.
whether at least relay this small message to people that look, I'm not tolerant of high inflation, the Bitcoiners and such like, that come on, I'm not failing big time. So Shakti Kanta, amazingly, it's like first time, I give like 10 on 10, especially in RBI, and I've been critical of many moves by RBI, especially in last decade. He's done wonderfully. Come on, now shift the stance is how I think he would do. Your voice
No,
is.
you kind of have to give some credit to the fact that in a really challenged last 18 months, uh, a number of things have worked out beautifully, and the central bank in India has been at the forefront. We didn't get any fiscal support worth its salt any which ways. Maneesh, I want to ask.
Just a thing. There's a counterfactual experiment. I mean, remove Shakti Kanta and some of the other men, in the office, and it shudders.
Yeah.
I'm saying, yeah. So I'm saying someone had to unwind the wrongs of pre-Shakti Kanta Das period, both on keeping things too loose and keeping things too tight, and actually not letting the business cycle rekindle. And I've been extremely critical of even the popular celebrity kind central banker in India. No, I think they made terrible mistakes. But my belief is that this man and the whole gang has done absolutely phenomenal job so far.
So far, the two keywords. Maneesh, I want to draw one more aspect. I remember a conversation that we had the last time. By the way, at some point of time after this question, I would love to understand one piece from you on that is on wage inflation in India too, and how do you see? Or maybe we do that and then I come to the markets piece. Very quickly, a quick 2-minute answer, Maneesh. What do you think of wages in India? Because they seem to be, by virtue of the focus on manufacturing, seem to be spreading out to the non-blue collared person, so to say, widening of that. And maybe that's the move. Maybe that's Modi's answer to Xi Jinping's prosperity for all, PLI schemes. But also that the white collar revenues, especially in tech-related spaces, is really moving up, and India has a large presence there.
Yeah, so I mean, India's sort of wage inflation is quite perverse, opposite of what's playing out in US and other developed countries, which is sort of more at bottom end. Okay, I mean, you really can't get the McDonald's and KFCs can't simply get the delivery boys, and salaries are sort of shooting up. So it's not the management, but not the super creamy layer, but the something beneath is what is getting big traction there. India is because our economy is sort of behind in terms of recovery. But we have a nice channel with US and many other countries who are actually pulling us up. Our inflation is more at white collar level, I would say, and especially starting with IT, starting to sort of express itself in some of it is in finance as well. So my sense is that in the tertiary setup, is services, you will see inflation returning pretty. I mean, I think I told you this, that I won't be surprised if the Mercer surveys and such like, would talk of 12, 13, 14% salary hikes in aggregate for the corporate India.
Yeah, well, interesting. Okay, now Manish, juxtapose all of this with a move that you made and you spoke about, at least last time, that you are largely sitting on cash out of equities as well. But here you also make a point that maybe we are not completely in the late cycle as yet. So did you take a call early than most that, chalo, let's be on equities because this might move too quickly? And you had said back then, Manish, that the value of a macro investor is to take a call, sit out of the ring, observe, because things will change in 3 months' time or 4 months' time. And then you might revisit your call if you have to. Do you feel the need to revisit your call, or do you believe it's in the right direction?
So, I mean, the most important thing in sort of making big money, Niraj, is to get in a position sizing in early cycles, which is like March, April 2020 is when I went all in, and I communicated to everyone that it sort of made sense to be in Indian small and mid caps, Yeah. And so it's sort of in early cycles, if you get into high beta in India or anywhere else in the world, you pretty much triple your money in 1 to 2 years. So this has happened in 9, 10, happened in 14, 15, happened in 2002, 3, 4. So these were the early cycles. You capture that, you pretty much earn for the whole decade within 1.5, 2 years. Then once you enter in mid cycles, I made this point that it makes sense to reduce the beta. So one way, of course, of doing is to exit all small and mid caps. That is the point I made, that let's exit all the small and mid caps and get into low beta. Either get into a diversified pool of Nifty and S&P 500. So that's the point I made, that it makes sense to exit the sort of active bets, and then neutralize your portfolios, only large caps, and then sort of stay out, continue to stare at sort of exit door. If we are entering the late cycle, then the whole of this Nifty, S&P combination and other large caps of sorts, depending upon whether you are a bottom-up or top-down investor, you have to sort of get into, as a macro investor, you have to get into a 10-year PSU bonds. So it's still not a time for 10-year PSU bond. We are still in a mid-cycle. I still suggest into my own portfolios, is still sort of predominantly large cap, Nifty oriented median portfolios. But the whole idea is to sort of desert all these positions if the sort of rate tightening actually plays out surprisingly on higher side in next 6 to 12 months. And I expect 10-year bond above 7% in 6 to 8 months time. And that is when 10-year PSU bonds could get to let's say 7.75 or thereabout. So 8% is a rate where I would think of actually switching all of these positions into 10-year PSU. So that's the way I try to transition in my portfolios and the portfolios that I'm managing of others.
Just wondering, quick follow-up. Could idiosyncratic events like India, I was reading a Bloomberg article yesterday on how a JP Morgan strategist had said that India's inclusion in that bond index might trigger big inflows into Indian bonds, etc. Could things like that? I had heard Rhythm Desai speak about the Morgan Stanley bond inclusion as well and what it could do to Indian bonds. Could those alter the landscape a little bit for a brief period, or no, not really?
Yeah, so India has a sort of an orthodoxy in not letting foreigners have great play in local bonds, because they've been sort of great beneficiaries of not allowing the offshore investors access foreign or we to raise money because that has sort of ensured that our vols in bond markets has stayed low. And to a certain extent, bond markets in India has been largely a playbook of RBI playbook, in a sense. The finance can't do much about it. So I think that orthodoxy still prevails in Delhi and Bombay both, Main Street and North Block. And I think they're not going to let go of these levers that they have on bond market. So in a sense, the inclusion and such like would incrementally make a few changes, but they're not going to be substantial. Again, India's fiscal deficit cannot solve itself out without substantial growth or inflation. Okay, so we solved our fiscal mess in 2001-3, through humongous nominal growth, primarily driven by real growth in 2004-8. Okay, we solved our fiscal mess, meaning which is again high fiscal deficit high public debt to GDP through unbelievable inflation in 2011-13. That no one anticipated in 9-10 rather, which is like inflation in teens for 3 years. Now again we are into that mess, that our fiscal deficit, public debt is near 90%, and you can't solve it through 6%, 5-6% growth with 5% inflation. You get to have the nominal stuff higher. Either get the 9%, 8% growth for a few years, or get at least 7-8% inflation for next few years. So in a sense, our 3-year the fiscal deficit, is even 3 years out would be actually substantially higher than pre-COVID. Okay, we don't have the wherewithal to finance that much, internally, and so to that extent, I think I have a dispute with bond markets, and with many players that I talk to, that this belief that India's terminal repo rate, okay, which is no one bothers about now the when will tighten happen, but to what extent you will tighten, which is what I call terminal repo rate. This belief that terminal repo rate in India is going to be 6% one is in conflict with what has happened in India in every past sort of expansionary setup. And two, that, with such elevated fiscal deficit of today and even 3 year out, I see no visibility of, curves. Once sort of RBI take the foot off, I see no visibility as to what will finance government bond at sort of reasonable spreads over repo. And therefore, I think in India, bond markets fell off. Whenever RBI sort of surprises markets on the other side, would be much nastier than you would see in many other developed countries. So I'm actually more worried, in terms of, positioning. It sort of makes sense for people to stay ultra low duration right now, because if RBI surprises, there is going to be a fairly nasty outcome for you as an investor in long bonds.
Yeah. No, that's true, and the probabilities are now starting to emerge that might happen sooner rather than later, and maybe at a pace which is different than what's been told in the past. Maneesh, one final question, and that is how closely you observe, for lack of a better word, geopolitics. So, though you can call geopolitics, geopolitics as well. The whole US-China issue. There are always these strains of Taiwan thrown in every now and then, or maybe that's the center stage. And yesterday, we've had numerous mentions of how the Indo-China issues as well are now taking center stage, if you will. How big a factor could this be on various issues, including equity investing? If you've observed that at all. Sorry, I'm throwing this out of the blue at you.
No. So I know it's as far as China and our northern neighbor is concerned, we made a tryst with our destiny. I mean, it's a permanent feature for next 100 years. That they're going to be a pain. In their algo, taming India is a prerequisite for Asian dominance. And so to the extent, I'll be surprised if they do not continue to do things, to prick us, and they will do it. So it's India's. So we cannot believe that Hindi Chini bhai bhai and set up our policy. We ought to believe that northern neighbor of ours, would continue to prick us and therefore set up Quad and everything else, Asian NATO and whatnot, and be friendly with our Western neighbor and such like. So all of that, is why it's called geopolitics. You're wedded to your geography and really can't do away with it. But the one or two more important things that you referenced, one is, of course, the US-China, purely from economics point of view, has large implications. One is that, the whole supply chain sort of built on the edifice of, that we are one world, Vasudhaiv Kutumbakam. And now it's not Vasudhaiv Kutumbakam, there are two Kutum, so to say. And if, to that extent, there's going to be separation and disintegration of supply chain, which is sort of capital intensive. And perhaps at least in medium term inflationary. So to that extent, this whole China plus that we get excited about, as far as India's growth is concerned, all good, right? But it also has inflationary sort of dragon built in there. Okay, so that's one geopolitics that at least in medium term, would have large implications, for inflation, favorably for India for growth. But, policy uncertainty, if that is something in your mind as a macro investor is a significant thing, that's sort of going to rise because we are transitioning from a unipolar one power world to bipolar, at least two power worlds, so to say, which sort of do not see eye to eye. So that's one, Niraj. The second thing, of course, which is as big, if not bigger, as far as markets are concerned, is the climate change policy. In a sense that our belief, Niraj, that our climate change policies which induce renewable energy promotion, okay, we thought until about few months ago, and we meaning all the policymakers, politicians, and people like such like, thought that there is no trade-off there. This belief that we will transition from fossil fuel to renewable energy without you and I paying necessarily more for the toy that we bought for our kids. Okay, that's not true. The transitioning will happen through various things. One is innovation, technology, and such like, but also higher prices of fossil fuel. Okay, so I cannot imagine, Neeraj and Manish, altruistically choosing an expensive electric car just to save the climate of the city, and letting go of a $40 of crude. Crude ought to be $120, $30 and terribly expensive for Neeraj to actually take that Adam Smith view that no, I'll take care of myself, and my God, everything is better off because of that. So the pivot to that is actually high hydrocarbon prices, and therefore I think markets are somehow getting this wrong. That a lot of surplus of, and I made this point to you many times, that energy prices are headed higher and higher and higher, and there is a policy tolerance to it to the extent, and I'm talking of medium term here again because we're talking geopolitics. There is a policy tolerance to that extent because it is an instrument through which you actually apply climate change policy. That dissuade Neeraj and Manish's of the world to sort of use less hydrocarbons, and which, by the way, is a great deal for OECD pack. I mean, US and all, postmodern economies, but it's a bad news for a country like India. And so anything, what sort of, while I'm extraordinarily bullish on India's prospects given our debt and demographics, but what sort of keeps me extremely worried is, what if the energy sort of landscape, changes dramatically. And that would actually slow us, very sharply in medium term, if at all that were to happen.
You can sense that Delhi is worried, right, Manish? Which is why the ethanol policies and this whole push towards EVs in whichever shape or form, if you can reduce that bit of import, it probably just helps. I think.
It does. But you and I and everyone, including Gadkari's and Satellite, would know that that these things sort of are slow moving. They you can't solve, as someone says, right, supply side as quickly as you do the demand side.
Yeah.
You can't put oil in the pocket or in the tank of Neeraj, car. It's far more difficult than transferring money to Neeraj.
No, that is that is completely true. But one just hopes that some of the policies that they're embarked on in a meaningful way does succeed. I think I went to a couple of car dealers just to find out, and they said that the ethanol blended vehicles are already out there and running.
Yes.
For whatever shape and form it helps. Yes. But great, Manish, great having you. Thank you so much for talking to us today and giving us your thoughts. And to you and yours, from all of us at BloombergQuint, a happy Diwali and a prosperous new year.